Hey everybody, I'm Jason and this is Supply Demand Daily. I keep tabs on the economy so you don't have to, and today we're going to be talking all about the real economy. Our journey is going to begin in the United States, where we're going to be looking at jobless claims, the weekly indicator that I talk about every Thursday pretty much. Then we're going to look at the demand for manufactured goods here in the US. We're going to take a little detour over to Korea, where we're going to look at Korea's industrial production numbers, and then we're going to finish in the Euro area, where we're going to look at the business climate indicator. If you don't know what any of that stuff is, that's totally fine. I'm going to tell you exactly what it is so that by the time this video is over, you're going to know all about it. You're going to be the expert, and you're going to need to strap yourself in, because in order to hit all of these destinations in 15 minutes or less, we're going to have to go somewhere between, I think, the speed of sound and the speed of light. But I'm not a physicist. I'm just an idiot who looks at charts and graphs and works in finance and knows some stuff about economics. So don't take my word for it. Maybe ask a physicist. I don't know any, but if you can find some, then let me know. All right, so let's go ahead and get right into it, shall we? All right, so we're going to start with jobless claims. We had the 12th consecutive week of increase in jobless claims so far in this past business week, the one that ended, I believe, June 23rd. And so what we're showing here is a chart that goes all the way back to January of 2021, which by my usual time scales is not long. The reason that I'm doing it this way is because when you include the COVID lockdowns in the initial claims chart, in the unemployment claims chart, what ends up happening is you drown out all of these smaller changes, because there were millions and millions and millions of jobless claims in those short couple of months when lockdowns first began, and that basically drowns out all of the variation in the rest of the series. So it's helpful, just to, when you're looking at these charts, it's helpful just to take that out altogether, because while that is important and it definitely happened, that's not the period that we happen to be studying today. So we've had the 12th consecutive increase in initial unemployment claims. What that is that is the total number of people in the U.S., this is data that's recorded by states, who are filing for unemployment because they have been laid off from their jobs. So not people who have elected to quit by their own decision, but people who have been laid off from their job. This is the 12th consecutive week that this particular number has been increasing. Why do we use a 4-week average? Well, because there's a lot of noise in this particular data that makes it kind of hard to extrapolate what the real trends actually are, what's going on structurally to the labor market. And so by taking a 4-week average, we eliminate some of that noise and we get a better picture of what's going on. What did the economy look like at other times when the rate of initial claims had been going up for 12 consecutive weeks? Well, it's really not all that pretty. So what I'm showing here is a chart where the blue bars indicate any time that the rate of initial claims had been going up for 12 weeks or more. And then the orange bars here signify the beginnings and ends of U.S. recession. So the beginning of the orange bar is the beginning of a U.S. recession. That is when production and employment in the U.S. economy are going down. And then the end of an orange bar is the end of one of those periods when the growth in the economy starts to pick back up again. And these blue lines are any time that the United States labor market has had 12 weeks or more of initial unemployment claims. Now, what we get from this chart, if you are not looking, or you can probably tell if you are looking, is that each and every time that we've had 12 or more weeks of increase in initial unemployment claims, there you have either been in the middle of a recession or about to be in one within something like 3 to 7 months. Not much longer than that at all in this data set. You're at most 7 months away and at the least 2 to 3 months away. So is that a good signal for the economy? I would probably say not. But this, fortunately, is the worst news that we're going to be talking about today, because it does get a little bit brighter as the charts go on. So let's go over to core capital goods. This is the rate of change in millions of, rate of change in percentages of the amount of capital goods that were ordered in the particular month in question over time. Now, this is kind of an interesting way of doing rate of change. What I've done here is 3-month annualized. And if you watch my videos, you'll find that I do that quite a bit. So this 3-month annualized thing. To explain to you what that means in English, basically take the amount of change over the last 3 months. So we're trying to eliminate a little bit of noise in the data here. We only want to get trends. We want to see what the broad picture is. So take the change over the last 3 months and you basically simulate what it would be like over the course of a year, what the rate of change would be over the course of a year if the remainder of the year were like the last 3 months. And so that's what's shown here. By annualizing it, we are able to eliminate some of the noise, as well as taking the 3-month change. We're able to eliminate some of the noise, and then we can also kind of compare it to other metrics that are conventionally measured on a year-over-year basis. So that's why we do that, and that's why I think it's a useful indicator. If you look at the raw rates of change in this particular chart that I'm showing here without this 3-month annualization, it does look a little bit more noisy. So this allows us to kind of extrapolate what's really going on. And what do we see here? Well, in the last month, so May of 2022, on a 3-month annualized basis, we had a rate of increase in capital goods orders in dollars. I'm going to come back to that in a minute. So capital goods orders in money terms of 8%, and that is about double what the average in this particular index is, going all the way back to 1992. So the average 3-month annualized rate of change going all the way back to 1992 is 4%, and we grew at 8% in May. Now that's pretty solid. It's pretty solid considering the amount of language and talk there is in the media and the press about how we're almost definitely going into a recession very soon. It looks pretty good. Also notice another positive thing that I want to impart to you about this chart is that if you just look at the change over the last couple years, basically ever since the end of lockdowns, and compare that to the couple of years that preceded the COVID panic, notice that the drop-off in this core capital goods metric actually started before COVID, so it was looking like an economic contraction, aka a recession, even months before COVID started. All right, so notice that the average growth rate across this last 2-year period versus the 2 years prior to the pandemic is actually a lot higher. I mean, you can tell just by looking at it, we have much fewer months below zero and a lot more months above zero. And then we don't have exactly these peaks that you see here prior to the pandemic, but there's definitely a lot more solid months of growth. So I thought that was definitely very interesting. Now, why do we specify core capital goods? All that means is that we are measuring capital goods orders, but we're excluding defense products. All right, so your guns and your ammunition and satellite guided drones and all of those kinds of things, and we're excluding aircraft. These are thought to be directed by other forces outside of the U.S. economy, and so they are often excluded when analyzing this data. And sometimes I don't think that excluding certain product groups is necessarily a good thing, like when we look at inflation. But I think in this particular regard, because defense spending and defense orders are orchestrated by the United States government rather than the fundamentals of the economy, I think that that's actually okay. One thing that I do want to point out about this, though, is that the producer price index for these kinds of goods, these core capital goods, is 12.4% as of May. And we had an annualized increase of 8%, which means inflation was probably around 4, maybe 5% of that. Now, let's talk about what core capital goods are in the first place. I'm showing a clip now, and this is just a short clip of a laptop factory. Now notice the laptop that is rolling off the production line, literally. It's rolling off of an assembly line on a conveyor belt. That is what's called a manufactured durable good, a good that you would use for 3+ years. That's usually the economic definition of a durable good. The capital goods are basically everything else in that shot that you see around it. So it's the metal bars, the aluminum bars that are surrounding that conveyor belt. It's the conveyor belt itself. It's the little wheels on the conveyor belt that are going to have to be replaced if they ever break. It's all of that other stuff. All of the tools and equipment that the workers use in order to put these laptops together, that's capital goods. And then that durable manufactured good is what rolls off the production line, and that's what we're going to talk about in this chart here. The rate of increase, again, we're talking in a 3-month annualized basis. Once again, the rate of increase in orders of durable manufactured goods, such as laptops, such as cars, it's up 7% on a 3-month annualized basis. This is in comparison to a 30-year average, again, going back all the way back to 1992, of just about, I need to change my scene here. This is not working. There we go. A little bit better. This is of about, so the average increase over the last 30 years, going back to 1992, is just under 6%, so 5.9. I see a similar pattern when I look at this chart with a higher average increase in durable goods orders after the pandemic than I see before it. And I also see this pattern of we have a lot more negativity in 2019 going into 2020, long before anybody even knew that COVID was going to be on the horizon. This is also subject to a large increase in prices. Again, the producer price index is running at about 12.4% for some of these types of goods as of May of 2022. So basically, a great deal more. There was more increase in the prices of these things than there was in the actual quantities ordered. And we can tell that because these figures are measured in nominal prices, which is also called current prices. And that just means that they're measured in money terms. So if you were totaling up the durable goods orders, you would take the amount of money spent on durable goods, not necessarily the amount of products that were ordered. And so it's necessary to think of them in terms also of inflation when putting together a real picture of what the economy looks like. So it does look like in this last month, and probably for many months prior, going all the way back to probably April of 2021, when this inflation started to really get going, that some of this, if not all of this, has been due in large part to the increase in prices. And maybe these companies that are ordering these capital goods and these manufactured goods are actually just paying more for the same amount. That's a conversation for a different day. Let's look at industrial production in Korea. What is industrial production? It is a way of measuring economic output, i.e. production, as indicated in the title, that is not related to prices at all. So this isn't measured in money terms. It is just a quantity-based index of things produced by manufacturing industries in the economy of Korea. And that's really good because especially when we're in an inflationary environment like this, it's good to see, indexes and indicators that don't have anything to do with prices, because that can affect the picture that we draw from it. We had a 6.1% increase in industrial production in Korea on a 3-month annualized basis, just like all of the rest of these charts. And the average rate of increase going all the way back to the beginning of this series is 2.3%. Actually, that's not true. This is a 10-year average going back to 2012. So 10-year average, 2.3%. So more than double the 10-year average. That's not bad. And this is a good sign out of Korea, because Korea is a manufacturing center within East Asia. A lot of stuff is made in Korea. If you look at any of your electronics, you will know that to be true for sure. And we do see a pattern where the last couple of years, ever since the pandemic, has actually been quite a bit better than the years that preceded it. So see this pattern throughout the production numbers and the manufacturing numbers for these couple of different countries, the US and Korea, and it is good to observe and appreciate that. The last thing we're going to look at is the business climate indicator in the Euro area. So this is not the European Union, it is the Euro area, which means it includes countries that are not necessarily in the European Union, such as, Ukraine and the United Kingdom and other countries like that, countries that don't necessarily use the euro either. Now, The 5-year average in this particular metric is 0.65% growth, and we saw in May a growth, actually of June, excuse me, this is June, not May, of 1.7%. So this was the business climate index, which is basically a measure of sentiment that is given by surveys. So a survey is sent out by the statistical agencies within these EU countries, and they ask business owners and manufacturing managers and all of these different folks about production, about exports, about inventories, and about their plans to hire, so employment. And then they collate it into this one number between, I believe, -3 and +3, and that creates a business climate index, basically one number that is designed to tell you what are business conditions like. Are they good or bad, and how good and how bad within the entire Euro area. So we are sitting at a level that is more than double the all-time average of this series, which goes all the way back to 1985, which is a lot higher than I would expect given everything that's happening in Europe between the war and the energy crisis that we're in basically the 9th or 10th month of. And so this is actually quite encouraging to see, even though we do have a downtrend. It's very important to note that we certainly had lackluster growth before the COVID-19 pandemic, and after it, we've seen, we've seen some solid improvement in economic conditions, both in the U.S. and Korea, as well as Europe. Not amazing, but not terrible either. Does all of this mean that a recession is not going to happen? Not necessarily. You should not draw that conclusion. Again, the rate of inflation has a great deal of impact on what these different indexes and not the indexes, but have a great impact on these capital goods and manufactured goods orders numbers, because all of those measures are done in dollars. All right, so inflation and prices definitely has an impact on that. I'm not saying that you should change your investment outlook if you've been expecting a recession for the last several months, which you probably have if you've been getting your information from me. I'm not changing my outlook based on this information, but it's just important to temper what you see in the media and maybe take a more nuanced look at what's going on in the global economy. I'm running at a little over 17 minutes. So with that, I'm going to call it a day, and I hope you enjoyed this episode of Supply and Demand Daily, and I hope to see you again next time. Have a good one. Take care. Thank you very much for attending. Goodbye.